The world of global finance is witnessing a seismic shift. Behind closed doors and far from the headlines, China has been making calculated moves that could shake the very foundation of American economic power. These actions are not sudden or impulsive. They are part of a carefully crafted strategy that has been unfolding over years. The result could be something the United States has never faced before: a historic liquidity crisis that threatens the dollar's dominance and America's financial stability. To understand what is happening, we need to look at the basics. Liquidity means having enough cash or assets that can quickly turn into cash. For a country like the United States, liquidity comes from its ability to borrow money by selling Treasury bonds to other nations. For decades, countries around the world have bought these bonds. They trusted the dollar. They needed the dollar. But now, something fundamental is changing. China has been one of the biggest holders of U.S. Treasury bonds for many years. These bonds are essentially IOUs from the American government. When China buys them, it lends money to the United States. In return, China gets interest payments and a safe place to park its massive foreign exchange reserves. But the relationship is shifting. The numbers tell a story that should alarm anyone paying attention to global finance. In 2022, China cut its holdings of U.S. Treasuries by $173.2 billion. The following year, it sold another $50.8 billion. In 2024, China dumped another $57.3 billion worth of American debt. As of December 2024, China held only $759 billion in U.S. Treasury securities. This represents the lowest level since 2008. The trend is clear and accelerating. China is systematically reducing its dependence on American debt. But China is not just selling U.S. bonds, it is buying something else: gold. Lots of gold. For 10 consecutive months through September 2025, China's central bank purchased gold every single month. Unofficial estimates suggest China now holds between 5,000 and 5,500 metric tons of gold. That is more than double the officially reported figure of 303.5 tons. China is quietly building what could become the world's second largest gold stockpile, closing the gap with the United States. Why does this matter? Gold represents an alternative to the dollar. For centuries, gold has been the ultimate store of value. It cannot be printed like paper money. It cannot be devalued by government policy. By accumulating massive gold reserves, China is creating a financial cushion that does not depend on American goodwill or the stability of the dollar. This is not just about diversification. This is about creating alternatives. The strategy goes much deeper than just gold and bonds. China has been working methodically to internationalize its currency, the Yuan. For decades, the US dollar has been the world's reserve currency. Global trade, especially in oil and commodities, has been conducted in dollars. This gave America enormous power. It could print money, run deficits, and impose sanctions because everyone needed dollars. But China is building a parallel system. In 2015, China launched the cross-border interbank payment system known as CIPS. The system allows banks around the world to clear and settle transactions in yuan without using dollars. Think of it as China's alternative to SWIFT, the Western-dominated financial messaging system. As of mid-2025, CIPS has expanded to 189 countries and territories. It now connects with over 11,500 financial institutions. In just the first half of 2025, CIPS processed $12.7 trillion worth of payments. The numbers reveal the speed of change. In 2022, only 20% of China's trade was settled in yuan. By 2025, that figure jumped to nearly one-third of China's $6.2 trillion in annual trade. Transaction volumes through yuan clearing banks rose by 43% in 2024 alone, reaching 175 trillion yuan, which equals about $24 trillion. The yuan is not replacing the dollar overnight, but it is steadily carving out space in global commerce. China has also been converting dollar-denominated loans to yuan-denominated loans in developing countries. Through its Belt and Road Initiative, China has lent hundreds of billions of dollars to nations across Asia, Africa, and Latin America. Now, it is offering to convert those dollar loans into yuan loans. For countries worried about dollar volatility or U.S. sanctions, this is an attractive option. Each conversion reduces global dollar demand by a small amount, but these small amounts add up. The BRICS nations, which include Brazil, Russia, India, China, and South Africa, plus several new members, are also working on alternatives. They are developing BRICS Pay, a payment system that would allow member countries to trade using their own currencies instead of dollars. While a unified BRICS currency faces major obstacles, the payment infrastructure is real and expanding. The message is clear. Major economies are building systems that bypass the dollar. Now let us look at what this means for the United States. The American government runs large budget deficits every year. In fiscal year 2025, the budget deficit reached $1.8 trillion. That is 5.9% of the entire economy. To cover these deficits, the government must borrow money by issuing Treasury bonds. Someone has to buy those bonds. For decades, foreign buyers, especially China and Japan, eagerly purchased American debt. But demand is changing. While overall foreign holdings of U.S. Treasuries reached an all-time high in July 2025, this masks an important detail. China is selling. Japan and the United Kingdom are buying more. But what happens if more countries follow China's example? What happens when the pool of eager foreign buyers shrinks? The answer is simple and frightening. The U.S. government would struggle to borrow the money it needs. This is where liquidity crisis enters the picture. A liquidity crisis happens when there's not enough cash available to meet financial obligations. For the U.S. government, this would mean difficulty selling Treasury bonds at reasonable interest rates. If fewer buyers want American debt, the government would need to offer higher interest rates to attract investors. Higher rates mean the government pays more to service its existing debt. The numbers are already concerning. As of November 2025, it costs the United States $201 billion annually just to pay interest on the national debt. That represents 17% of all federal spending. The average interest rate on federal debt has more than doubled from 1.5 to 56% in January 2022 to 3.352% as of July 2025. As rates rise, so does the cost of borrowing. This creates a vicious cycle. Higher borrowing costs mean bigger deficits. Bigger deficits mean more borrowing. More borrowing at higher rates compounds the problem. The national debt itself has reached staggering levels. As of September 2025, the total outstanding debt stood at $37.4 trillion. The debt held by the public was $30.1 trillion. This equals roughly 97% of the entire American economy. Historical experience suggests that when debt levels exceed 100% of GDP, economic growth slows and financial instability increases. The United States is already at that threshold. What makes China's moves particularly powerful is the timing. The U.S. Treasury market has shown signs of stress in recent years. In April 2025, liquidity in the Treasury market declined to the lowest level since March 2023. While conditions improved later in the year, the underlying fragility remains. Treasury market liquidity is crucial. These bonds are considered the safest assets in the world. They serve as collateral for countless financial transactions. If liquidity dries up, it affects the entire global financial system. China understands this vulnerability. By reducing its Treasury holdings gradually, China avoids triggering a panic. A sudden massive dump of U.S. bonds would hurt China too, as the value of its remaining holdings would plummet. Instead, China is executing a slow, strategic retreat. Each quarterly reduction of $15 to $20 billion seems manageable, but over years, it fundamentally reshapes the market. The implications extend beyond government borrowing. American consumers and businesses also depend on liquid, stable financial markets. Mortgage rates, corporate bonds, and credit card interest rates all tie back to Treasury yields. If the Treasury market becomes unstable, borrowing costs rise for everyone. Businesses invest less, consumers spend less, economic growth slows. In severe scenarios, a liquidity crisis could trigger a recession or even a financial crisis similar to 2008. China's strategy also includes building credibility for the yuan. In November 2024, China issued $4 billion worth of dollar-denominated bonds in Hong Kong. Remarkably, half of those bonds were priced at no yield premium compared to U.S. Treasuries. This means investors viewed Chinese government bonds as equally safe as American bonds. This is a stunning development. For China, or S bonds, to compete on equal terms with U.S. Treasuries represents a major shift in market perception. The Federal Reserve has limited tools to counter this trend. The Fed can buy Treasury bonds itself through quantitative easing, but this essentially means printing money, which can fuel inflation. The Fed already expanded its balance sheet dramatically during the COVID-19 pandemic. Additional massive bond purchases would raise questions about fiscal dominance, where monetary policy becomes hostage to government financing needs. This would further undermine confidence in the dollar. Some argue that the dollar's dominance is unshakable. They point out that 59% of global foreign exchange reserves are still held in dollars. The dollar remains the primary currency for international trade. American financial markets are the deepest and most liquid in the world. These points are valid. But they miss the direction of change. 20 years ago, the dollar's share of reserves exceeded 70%. The decline is real and continuing. The rise of alternatives does not require the dollar to collapse. It only requires the dollar to lose its monopoly. When countries can trade in Yuan, settle payments through CIPS, hold reserves in gold, and access credit through BRICS mechanisms, they become less dependent on dollar-based systems. This reduces American leverage. It limits the effectiveness of sanctions. It constrains America's ability to finance deficits through foreign borrowing. The geopolitical dimension adds urgency to the situation. U.S.-China relations remain tense. Trade tariffs, technology restrictions, and strategic competition create an atmosphere of distrust. China has watched the United States freeze Russian foreign exchange reserves held in Western banks. Chinese leaders understand that their dollar assets could theoretically face similar treatment. This creates a powerful incentive to reduce dollar exposure and build alternative systems. The problem for the United States is structural. The federal government has become accustomed to running large deficits. Political gridlock makes it nearly impossible to either cut spending significantly or raise taxes substantially. Social Security, Medicare, defense, and interest on the debt account for the vast majority of federal spending. These are politically protected. Meanwhile, tax increases face fierce opposition. The path of least resistance is continued borrowing. But borrowing depends on willing lenders. For decades, the United States has benefited from what some economists call exorbitant privilege. The world's demand for dollars allowed America to borrow cheaply and live beyond its means. The privilege is eroding. As China builds alternatives and other countries follow, the pool of willing lenders shrinks. The U.S. government will still be able to borrow, but it will cost more, perhaps much more. The speed of change is accelerating. China Yuan has gone from settling 20% of Chinese trade in 2022 to nearly 33% in 2025. That is a 65% increase in just 3 years. Gold prices have surged as central banks, led by China, accumulate reserves. The infrastructure for dollar alternatives from CIPS to BRICS pay is not theoretical. It is operational and growing. History offers sobering lessons. The British pound was the world's reserve currency before the dollar. Britain's imperial power and London's financial dominance seemed unshakable. But 2 world wars, mounting debts, and the rise of American economic power changed everything. By the 1960s, the dollar had replaced the pound. The transition was not instantaneous, but it was irreversible. Could the same thing happen to the dollar? Not everyone agrees that a crisis is imminent. Some economists argue that China faces its own massive problems. Its property sector is in crisis, with 27 months of housing inventory. Its economic growth has slowed significantly. Its population is aging rapidly. Its financial system carries enormous hidden debt. These challenges are real, but they do not negate China's strategic moves away from the dollar. In fact, China's economic troubles may make de-dollarization more urgent from Beijing's perspective. The path forward for the United States is narrow and difficult. Restoring fiscal discipline would require political courage and painful choices. Raising interest rates to defend the dollar would slow economic growth and increase borrowing costs. Trying to prevent other countries from building alternative systems would likely accelerate their efforts. The tools available to policymakers are limited, and each carry significant costs. Meanwhile, China continues its methodical approach. It sells U.S. treasuries gradually. It buys gold steadily. It expands Yuan clearing arrangements. It builds payment infrastructure. It converts dollar loans to Yuan loans. None of these steps alone would trigger a crisis. But together, they are reshaping the architecture of global finance. The foundation beneath American financial dominance is developing cracks. The ultimate question is not whether the dollar will collapse tomorrow. It will not. The dollar remains dominant. But the question is whether the United States is heading toward a liquidity crisis where it struggles to borrow the massive amounts it needs at affordable rates. The evidence suggests this risk is real and growing. China's latest moves are not causing the crisis, but they are certainly pushing the United States toward a dangerous inflection point. The American economy remains the world's largest. Its military is unmatched. Its technology sector leads globally. But financial dominance depends on confidence. It depends on the belief that dollars are valuable, that U.S. bonds are safe, and that the system will endure. China is methodically undermining that confidence. Not through confrontation, but through construction. It is building alternatives that give countries options they never had before. For ordinary Americans, the consequences could be profound. Higher interest rates would mean more expensive mortgages, car loans, and credit cards. Government spending cuts or tax increases might be necessary to manage deficits. The dollar's purchasing power could decline, making imports more expensive. The standard of living that Americans have enjoyed could face pressure. These changes would not happen overnight, but they could unfold over the next decade as the cumulative effect of China's strategy becomes undeniable. The irony is that America's fiscal policy makes China's strategy possible. If the United States ran balanced budgets or small deficits, it would not need to borrow trillions from foreign lenders. If federal debt were manageable, rising interest rates would not threaten a crisis. But the political system has proven unable or unwilling to address these issues. Each year, the deficits continue. Each year, the debt grows. Each year, the dependence on foreign borrowing increases. And each year, China and others become more willing to explore alternatives. The historic nature of this moment should not be understated. For 8 decades, the dollar-based system has been the foundation of global commerce and finance. The post-World War II order that created American dominance is facing its greatest challenge, not from military conflict, but from financial engineering. China has studied the system carefully. It understands the system's vulnerabilities, and it is exploiting those vulnerabilities with patience and precision. The United States still has time to respond. Fiscal reform, investment in competitiveness, and diplomatic engagement could help maintain confidence in the dollar, but time is not unlimited. The longer the deficits continue, the more debt accumulates, and the more alternatives develop, the harder it becomes to reverse course. China's latest moves are a warning. They signal that the financial architecture that has supported American power is under serious stress. Whether this leads to a full-blown historic liquidity crisis depends on choices made in Washington and Beijing, but also in capitals around the world. Will other countries follow China's lead? Will markets continue to absorb American debt? Will political leaders find the courage to address fiscal imbalances? These questions will determine whether the United States can maintain its financial position or whether China's strategic patience will force a fundamental restructuring of global finance. The game is being played right now. The moves are subtle but consequential. China is not seeking to destroy the dollar. It is seeking alternatives, so it does not depend on the dollar. For the United States, this distinction may not matter. The result could be the same: a liquidity crisis that forces difficult choices and marks the end of an era of unchallenged American financial dominance. The only question is timing. And based on China's latest moves, that timing may be sooner than most Americans realize.